Hello, Accounting Superstars. Welcome to the Accounting Superstar channel. This is Professor Don Bush. I'm so glad you're here. We're going to learn a little bit more about depreciation, a little bit of a review. This lesson is for people who are in their first accounting class, probably in their third week of class, fourth week of class, and we're learning a little bit about depreciation. Pretty easy concept. Although it's not what a lot of people think it is. A lot of people think that depreciation is losing value. My car is depreciating, my computer is depreciating, my boat is depreciating, and that's true. That's how we speak English. That's how most people use the word depreciation. But in accounting, we use it as allocating the cost over the years of useful life, or expensing an asset, to say it another way. So here's what we have happening, folks. We've got social media partners. They bought a brand new computer. Look at this beautiful old IBM computer. It's probably from 1985, I would think. So anyways, they paid $6,000 for this computer, and they expect this computer to last about 5 years. And after 5 years, it'll be obsolete. And I think it's probably obsolete already. But anyways, that's the computer that they bought. And folks, they feel after the end of 5 years that it'll probably have a value of about $500. So here at this little chart, the original cost right here, $6,000. And after 1 year, the market value is going to be cut in half. It'll probably only be worth $3,000 if they had tried to sell it at a garage sale or something. And then it'll be worth $1,000 after the second year, and $750. The value just drops like a rock. And at the end of 5 years, they are hopeful that they'll be able to sell it for about $500. That's what they're guessing. They're estimating. So here's the formula, folks, right here. Nothing new at all. So the annual depreciation is going to be the original cost minus the salvage value, divided by the number of useful years that they're going to, the useful life years. So here we go. All you do is take your original $6,000, minus away the salvage value. They think it'll be worth about $500, and then divide it by 5 years. And if you do the math, I already did the math. If you do the math, you get right here. Let me get the right color. There it is. $1,100, and you can check that out for yourself too. Just 6,000 minus 500 divided by 5 years. So there you go. So each year, the accountant would do this journal entry right here. It's very easy. It never changes. It's always the same. Depreciation expense and accumulated depreciation. And depreciation expense always goes on the left-hand side. Expenses are debits, so just put that first. And it's for $1,100. And accumulated depreciation, that is going to go on the balance sheet, and that's for $1,100 too. And so coming down here on our income statement, now hopefully by this stage of the game here, I know you've only been in accounting class for 2, 3, 4 weeks, but I hope you know that on the income statement there are only two things that go on the income statement: revenues and expenses. And I know I've said this in the past in other videos, but don't ever put anything else on the income statement. Only revenues and expenses. So don't be putting cash, don't be putting retained earnings, don't be putting accounts payable. I mean, I've seen everything on this income statement and it doesn't belong there. Only two things: revenues and expenses, nothing else ever. All right, so depreciation expense is going to go down here to the income statement, and it'll show up on there. And over on the balance sheet, under the assets, we'll have something like this here. We'll have computer, the original cost, $6,000. And you might say, where'd you get that? Well, the original cost was $6,000. Less accumulated depreciation. Now, this is the very first year. There's only been 1 year here, so it's $1,100. Where's that number come from? Well, it came from our chart here and from our journal entry. And the book value, all you do for the book value is 6,000 minus 1,100, and you get the book value. And according to the books, this computer is worth $4,900. But in real life, in reality, they probably could only get maybe $3,000 for it. Now, this doesn't concern accountants, not usually. And all we're doing is we're just expensing this computer over the life of the asset. It has nothing to do with market value. So the fact that this 4,900 and this 3,000 don't match doesn't mean anything. Don't worry about it. It's okay. All right, well, let's do the second year. Well, in the second year, the depreciation will be the same, 1,100. Well, by the way, this is called straight line depreciation, what we're doing here. How do we get that 1,100? Original cost minus salvage value divided by 5 years. The journal entry will be identical right there. The journal entry always stays the same, and the journal entry is done each and every accounting period, or in this case, at the end of the year. Expenses go on the income statement because by now you know only two things go in the income statement: revenues and expenses, nothing else. And then over here on the balance sheet, it'll look pretty much the same, with the exception that instead of accumulated depreciation being 1,100, now we've got 1,100 times 2. All right, so we've got 2,200 minus 2,200. There we go. So the book value, folks, at the end of the second year is 3,800. And according to, if we were to sell this thing, we probably would only get $1,000. So the market value is only $1,000, but the book value here is 3,800. They're not the same. They're not going to be the same. Don't worry about it. It's all okay. Now, this would continue. All this fun stuff would just continue each and every year. Now, in the final year, in the fifth year, they'd have depreciation of 1,100, and we'd have depreciation expense of 1,100 here, and accumulated depreciation, exact same journal entry, it never changes. And the income statement, same deal, depreciation expense 1,100. Now, since this is the last year, our books would look like this. We'd have computer original cost 6,000, less accumulated depreciation. Now, it wouldn't be 2,200, but it would be 1,100 times 5, because we have now depreciated it for 5 years. So that'd be 5,500. So minus 5,500. And the book value is 500. Now, what's going on here is that they estimated, and it was all a guess. It was just, total guess. They thought, at the end of 5 years, it'll probably be worth about $500. So that's, right here, $500. And so that's how they figured out the depreciation. They said, salvage value probably $500. Now, the thing is that accountants like to try to get close to the market value at the end of the useful life. Now, and you could see that, in years 2 and years 3 and 4, that the book value and the market value weren't anything close at all. But at the end of the useful life, accountants like to try to get close here, and in this case, they are pretty good. Now, they're not going to know the market value for sure until they actually sell the computer. Who knows? Maybe it'll be a collectible and they'll get a lot of money for it, or maybe it won't be worth anything at all. So, and the accountant would take care of it at that time. So there you go, folks. Hope you enjoyed this lesson. Let me know what's giving you a bad time in accounting, and I'll make a video to help you guys out. All right, you got to let me know, and hit that like button and the subscribe button. That way these videos will be made available to more people, and it'll help out a lot of people. So anyways, talk to you later. Over and out.